Good afternoon. This is Todd Horwitz coming to you from the floor of the CME Group in Chicago, and today we'll continue to follow the U.S. Treasuries, and we're using the 30-year bonds. And I think really what we look at here is everybody is kind of fed up. You know, last week we had the Janet Yellen testimony, which was a little bit more of the double talk and things that they're looking for, which actually put a little pressure on the bond market. I mean, I think what we're looking at here now is that there's some fear in the markets, which I think has caused a little bit of this rally. You know, one of the things we look at, and we use the bonds, a lot of people use the bonds as an asset class to chase fear. You know, people talk a lot about the volatility index, but bonds are a real outstanding place that people do run to when they're a little bit of fear. So we've seen the bonds start to rally a little bit here the last couple of days, but I think, again, I would call the tops are in here. I think when you look at the overall picture in the model, I think you have to see higher rates. If the Fed doesn't make the rates higher, I think the bond traders will. I think the fixed income traders will. I think they need to see and want to see higher interest rates anyways. I think that's a better flow for the economy in general. So I think what you're going to see here is either the Fed will start to hike or the bond traders will start to sell these bonds down and force rates up artificially. There's a lot of things that can happen here, especially with the Fed balance sheet. If they decide to unwind, I mean, they could actually artificially hike rates by selling their position faster. But at the end of the day, we're looking to be a seller, and I think 156 now is low. We were at 158. We did have a sell-off down into the 153s. So now we're getting a little bit of rally back up here, and today they're a little bit softer, but overall, 156 would be the next level, maybe even 155 and a half. As we look for the push down, we're using obviously the December contract. So in the meantime, we look for the tops to be in. I think there's a lot of frustration out there that will also help escalate and push these down, driving interest rates higher. And I think that's really what we're looking forward here. So sell them at 156. That's the way I see it. This is Todd Horwitz coming from the floor of the CME Group in Chicago.